My dad always told me, don't step over dollars to chase pennies. And we see people doing that often. Today, we're going to give you kind of an example so you guys don't make the same mistake.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad Poor Dad along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso, and today we've got something special for you. Today we're going to be covering what we call the $1 million mistake. Anthony, this is going to be a good one.
Yes, I'm looking forward to it because this one, I'm just going to be like a pretty face or maybe just a okay face. I'm just going to be here I'm really curious to see your presentation of this. I know I've seen it before, and actually I was the one who suggested we do this for a podcast.
Yeah.
I think this is some great content here where a lot of people aren't seeing the big picture, which is what you're going to paint for us today.
Yeah, I agree. If you guys are out there and you guys are listening to this episode, this is the reason that this conversation comes up is because a lot of times people are focused on the wrong things. And so really the message today is kind of asking or reminding clients to step back from taking a micro approach to their finances to taking a macro approach to their finances. And when I go through this example, I think you guys will have a good understanding. And hopefully, right, some of you guys are out there probably making the same mistake. So we've got a good solution for you.
All right, let's dive into it, Cam.
Yeah. So like I said, guys, when people reach out to us, we often start by going through their finances. And I'm going to build a scenario with you. This is generic. I'm going to use round numbers. So it's simple math, even for an accountant. Exactly. So the scenario that I'm going to kind of describe to you is if somebody comes to us and they've got $1 million in net worth, right? If someone's got $1 million in net worth, they're not going to be investing the entirety of that million, right? They're always going to hold back some to have cash on hand. And so that's going to be anywhere from maybe 70 to 80%. In our example, I'm going to say that somebody's got 80% that's out there and invested. Does that sound fair?
Yeah.
Right. So 80% of that $1 million is out there invested in, could really be anything, right? It could be single family, multifamily, could be land flipping. And when you talk to somebody about those investments, one of the first things that we'll address is, hey, what's your expectation on return for those types of investments? Anthony, do you have, I know you're blind here, but do you have any idea as to kind of what people are chasing on that return side?
I mean, I think where people could be chasing more, they might be chasing like 10, sometimes 12.
Yeah.
But also most time those are going to be taxable. And we really need to focus more on after tax.
Yeah.
So I tell you what I try to look for is like 8% after tax.
Okay. Great. A lot of times when I talk to somebody, believe it or not, is especially seasoned investors, is they'll say, I don't get out of bed for 10% or less, right? So they're chasing those double-digit returns. So when I talk to those people, right, one of the examples that we'll put together is, hey, if I've got 800,000 out there and I'm earning 10% over a year, right, we're taking home $80,000, right? And everybody's super happy with that. And that's kind of the rate of return. The question there, or maybe the point that I have for clients is I ask them, how does that relate to the return on overall wealth? And they always go, well, what does that mean? And I said, well, we've got 20% or 200,000 in this example sitting over here. And what's it doing for us? Anthony, I don't know about your experience, but over the years, I've often seen that people are keeping that cash on hand in an account that's earning literally close to zero. Would you agree?
Yeah.
Right. So they're keeping it in accounts, typically a check in your savings, and it's earning zero because they have to keep it because it's got to be safe and liquid. And maybe the accountant comes along once a year and starts to urge them to put a little bit of money away as it starts to climb. But most of the time they're sitting on that cash. And so the point I'm making here is that oftentimes clients are hyper-focused on the investment side and they completely neglect the cash that is sitting there safe and liquid. And they are not getting a return on the 200,000. And that's what I mean by return on wealth. So if they are earning 10% on 800,000, that's 80. But if we take that 80,000 and we look at it as entirety of the entire portfolio on $1 million, the return on wealth is actually 8%. You following me?
Yeah.
Perfect. So when we take that approach, we ask clients to step back, take that macro look, we can see that there's a big gap in what they're doing. And so oftentimes the solution that we'll come in and propose is, listen, this is a perfect scenario for the infinite banking concept, right? What's happening in this scenario happens with almost every business owner and investor is we're stacking up cash kind of in between investments or while we're waiting to save up to make that investment, and or we're sitting on cash because we might need it, right? For capital expenditures, to buy equipment, anything else that may come along. So the solution in this scenario is we've got to go out there and we've got to earn a rate of return on the cash that we have sitting. It's very difficult to do, and this is not oftentimes done, is because people don't know where to go. And this is where we'll come in and we'll introduce them to infinite banking. Guys, if you have questions on infinite banking and you're not quite sure what we're talking about, reach out to us. We'd be happy to sit on a phone call with you and kind of go into this in detail. But really, one of the best solutions we can do with that cash is put it into a properly designed infinite banking policy. And now what you'll see is now we can earn an interest rate on the capital that's sitting and waiting for the next investment, but also we're going to keep it safe and liquid.
Okay.
Fair enough?
Yeah.
Right? So now what I want to do is I want to assign some numbers to this, is because conceptually, right, we've solved the problem here, but now let's see how big of an impact that this can create over time. All right. So Anthony, in that first example, right, we had 80,000 on what we earned.
Yep.
Right. And then we had 200,000 that was really just dead money. Would you agree?
Correct. Yeah.
Right. So we're earning zero on that. In the second example, what we've got to do is we've got to take that 200,000. We need to assign an earnings rate to it, or interest rate. And if we can take that 200,000 and for round numbers, let's say that we can earn 5% interest.
Okay.
All right, Anthony, you're the accountant. 5% on 200,000. How much would we end up with at the end of the year?
10 grand.
Perfect. Right. So now we take that 10 grand and we add it to the 80 that we had before. And now we look at our return on wealth, and now it's a 9% ROI, right?
Now, do you mind walking me through how you got to the 9%?
Yep. So in the first example I went through is we had 800,000, and that 800,000 is earning 10%. So we had $80,000 investments that were made over that first year, right? And then the 200,000 was earning zero. So the total return on wealth was 80,000. You take 80 divided by the million, we got the 8%. Okay. The second example that I was describing is we still got that same 800,000 that's earning 10%. So we've got 80 there, but now we're going to assign an interest rate to that 200,000. And if we can earn 5 or close to it, right, for round numbers, we're going to get another 10 over the course of 12 months.
Gotcha.
So we take 10 and we take 80, and now we've got 90 that we've earned over the course of a year. We take 90 divided by a million, and that gives us a 9% return on wealth over the course of 1 year.
Okay. I'll follow you.
Perfect. So here's another lesson, right? This is a conversation I have a lot of times with clients, is because most people will hear that, right? And they will kind of scoff or they'll disregard the increase on 1%, moving the needle from 8% to 9%. But if we go and we do the math on that, Anthony, if we look at the increase from 8% to 9% over the course of 1 year, what percentage of increase is that?
That would be a 12.5%.
Perfect, right? So guys, going from 8% to 9% is not a 1% increase. It's actually a 12.5% increase on our efficiency over just 1 year. This is really, really important because, again, right, one of the things that we like about using a properly designed policy is we've got increases, but they don't happen in just 1 year. They happen every single year after that. So in our example, if we can move the needle from 8 to 9% over the course of 1 year, and we do that every year moving forward, it's a minor change, but it's going to make a major impact on our financial future. Okay, so let's go through this. So now what we're doing is we're looking at two scenarios where we earn 8% versus 9%, right?
Yep.
All right. So Anthony, do me a favor. Can you take $1 million earning 8% over a 20-year timeline? What is that?
FYI, I don't want people to get confused that I am a mathematical genius. Okay. I am not. Cameron did prepare some of these numbers here. Okay. But really, you invest $1 million at 8%, compounded over 20 years, you're going to have $4.6 million.
Perfect. All right, Anthony. Now, if we take that same $1 million and we invest at 9% over that same 20 years, what do we end up with?
$5.6 million. That's $1 million more.
$1 million more, right? By making one simple minor adjustment, we actually end up with $1 million extra at the end of the day. And that is often overlooked. Anthony, let's add this too, is that if you take a look at this, this is often interesting. If we take the first scenario where we're earning 8% and we end up at 4.6, and we compare that with the result of the 9 and we end up at 5.6, what percentage increase is that over the same time frame?
That's a 20% increase dollar for dollar.
Isn't that crazy? I think it's crazy, right? And it's actually a 20% increase, like Anthony just said. And the result, or why we have that increase, is because that 12.5% efficiency that's increasing every year over that 20-year time frame. And so by making one little adjustment, we've got clients that are recapturing over $1 million, and it's actually a very easy thing to address when we actually identify and see it. But oftentimes it's overlooked. The thing I'd add here, Anthony, is that I also extended this example out. We're looking just over 20 years.
Yeah.
If we take this and we extend it out over 30 years, right, the numbers are even worse. $1 million, 8% over 30 years, you end up with $10 million, almost to the T. If you take $1 million at 9% over 30 years, you end up with $13.2 million.
So the longer the time frame, the bigger the bigger the difference.
Absolutely, right? So again, now we've got compounding kind of working in our favor. That difference is going to increase. It's still that same 20% difference, but now it's working for us. And my point on adding that last little part is that, guys, maybe your number is not $1 million, right? Maybe it's 500,000, but maybe, your difference is not $1 million, but maybe it's $3 million difference. And so the point that I want to make is often that when you sit down with somebody, they're often hyper-focused on the investment side. And if we can take a simple step back and take a look at the macro point of view, we're going to see some gaps that they have in their financial planning. And that's where we can come in. And that's a great fit for infinite banking to come in, fill that gap, and taking a minor adjustment that will make major outcomes in the future.
Well done, Cam.
Thanks, Faso. Any questions? Was that clear? What do you think?
Yeah, I do have some questions. Before I do, one thing came into mind is that, like what our mentor Nelson Nash talked about, it's not about rates it's about volume, meaning we're often chasing interest rates, whether it's on a loan or on investment. What's my interest rate? But we need to focus more on the dollars or the volume of dollars that we're going to get from deploying our money. And right here is an example here. People aren't really focused on, they're so focused on rates of return. That's what they're bragging about, to their buddies, but we really need to look at our whole aspect. So really appreciated that. Cam, a couple questions. Where can we get this magical? Where do you suggest that we store the money to get this return?
Yeah, great question. Guys, in this example, I rounded up to 5%. Right now, you could probably find 5 in high yield savings account, something like that. But where you're going to want to look to do this long term is you're going to want to look to use a properly designed life insurance policy from a mutual insurance company. And when I say properly, it's going to be infinite banking focused. That's going to be our specialty. That's what we've done for the last 15 years.
So just for people that are listening, maybe aren't familiar with infinite banking, we're using a whole life product. But typically I always hear a whole life product doesn't have cash value for a long period of time. The rates of return are terrible. But you're telling me something different.
I am. Yep, absolutely. So I'm telling you that we can get around 4%, maybe even higher in a proper design life insurance policy over a 20, 30-year period pretty easily. That's where the product is designed. That's the way they perform. What's different is the way that we design it, right? When you get a whole life policy, traditionally it's been designed for a death benefit. What we're doing is we're taking the products off the shelf that the insurance companies have, we're redesigning it, handing it back to them and asking them to issue it more for a cash performance type of a design. And so that's where some of the education or information that we have that we'll share with you guys.
Okay, that was great, Cameron. So I can see the advantages that you'd mentioned of just really making more money by doing this strategy. Are there any other advantages of storing your money in this type of product to what most people are probably doing?
Yeah, one of the major advantages is going to be creditor protection, right? Is depending on what state you're in, creditor protection is dictated by the state. So again, oftentimes clients will call in and they're sitting on a bunch of cash. And so, man, if you're an investor, you're a business owner, and you've got cash and checking and savings and you don't have that protected, man, that's a huge liability that somebody's carrying along the way. The other thing that I would add is that if you look at the investment side, we haven't even talked about taking kind of the insurance policy and leveraging it or collateralizing the cash value to improve what you're doing on the investment side. That is going to be a huge benefit and will just increase the returns that we've highlighted here. That's for another podcast. Today's episode is just really kind of addressing the low-hanging fruit. There's a lot of clients out there, a lot of individuals out there that are making this one simple mistake that we can fix pretty easily by highlighting it to them and then giving them a solution. So that was the point of today.
Cam, what's the of this account? What's the tax rate that we're going to pay on the zero? Well, he held up his hand.
Held up my hand as a big zero. Same number of dates that Anthony had in high school. Zero.
I'm not. You're true on both accounts. Okay. Well, what we always like to look at both sides, pros and the cons. What is a downside of incorporating this strategy?
Sure. Anytime somebody asks me what the downside of implementing infinite banking would be, is I'm always going to tell them, hey, when we start a policy, there is going to be a cost to it. So if you do make that decision to go and take this step forward to readdressing some of that cash, one of the questions you want to ask is, what's the cost to getting this thing started? And so our process, I can't speak for everybody, is to go through, design a good policy for you, make sure the one fits, and make sure that you understand that there are going to be a cost in the first couple of years. But again, if you guys are focused on a 20, 30-year time frame, there's going to be no better step that you can take than readdressing the cash into a policy. So we'll make sure that you guys see the costs and certainly the pros to it as well.
One thing I like to add, I'm sure some people are listening here saying, well, I'm getting 5% in my money market or my high yield savings. I will say, from what I've seen, 5% was possible maybe 6 months ago, but it's starting to go down. And even if you are getting 5 today, what were you getting 2 years ago? Probably 0.5. What are you going to get 2 years from now? Or we're using a 20-year example. What's realistic expectation of the next 20 years? I'm going to tell you, it ain't 5, right? And it ain't 0.5. Ideally, it should be somewhere here in the middle. And again, we need to stop focusing about interest rates, because like you'd mentioned, Cameron, not only are we getting a higher interest rate, but there's asset protection. It's tax-free. We didn't even talk about a death benefit. All right. So there's just, we just want to, there's so many advantages, I think, about incorporating this strategy, but we just try to focus on a couple. Great job, Cameron. Anything else you wanted to add?
No, I do like the point you made there on that high yield savings account. That has been an argument, maybe, right? That has come up over the last couple of years as interest rates have risen. And, every time somebody asks, right, I'll ask them, hey, what are you earning on the cash? And, they might put back and say, hey, I'm earning about 5 in this high yield savings account. And I say, how long you been doing that? And they'll say, about 6 months. I'd never said this, but I always think to myself, that's not bad, but I've been earning that for the last 15 years, right? So you're late to the game, man, right? I've been earning that for 15 years inside my policy. I will also say that typically I usually kind of promote that we're going to be closer to that 4% number. I like to set expectations low, but for this illustration, I was using generic numbers and easy math for this guy.
I'd like to end this, Cameron, telling you that you did a great job. And I've been doing this for almost 16 years. Go make a fantastic day.
16 years and 1 month. Take care.
If you like this video, I know you'll like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.